Why financing shapes the entire transaction. As we continue through Chapter 5, we now turn to one of the most critical components of any commercial deal: financing. While contracts, leases, and negotiations define the structure of the transaction, financing determines whether the deal can actually close. In commercial real estate, financing is rarely simple. It often involves multiple layers of capital, lender requirements, and strict underwriting standards. Understanding how financing works and how it interacts with the purchase contract is essential for successfully guiding clients through a transaction. This section builds directly on Section 5.2. While leases determine income, financing determines how that income is leveraged to acquire the property. Understanding the capital stack, how deals are funded. Commercial real estate financing is often referred to as the capital stack, which represents the different layers of funding used to complete a transaction. The capital stack typically includes equity, the buyer's cash investment; senior debt, the primary loan from a lender; mezzanine financing or secondary debt; additional borrowed funds. For example, a buyer purchasing a commercial property in Phoenix may contribute 30% equity while financing the remaining 70% through a commercial lender. In more complex deals, additional layers of financing may be added to bridge funding gaps. Understanding this structure allows agents to better evaluate the strength of a buyer and the likelihood of closing. Loan types in commercial real estate commercial financing differ significantly from residential loans. Common loan types include traditional bank loans, small business administration, SBA, loans, private or hard money loans, bridge loans for short-term financing. Each type of loan has different requirements, timelines, and risk levels. For example, an SBA loan may offer favorable terms but require extensive documentation and longer approval timelines, while a private loan may close quickly but at a higher interest rate. This directly impacts contract timelines and contingency periods. Financing contingencies, protecting the buyer. Most commercial contracts include a financing contingency, allowing the buyer to cancel the contract if they are unable to secure financing within a specified time frame. This contingency is a critical protection, especially in complex commercial transactions where financing approval is not guaranteed. For example, a buyer under contract for a retail center in Chandler may include a financing contingency that allows them to cancel if loan approval is not obtained within 45 days. Without this contingency, the buyer may still be obligated to close, even if financing falls through. This ties back to risk management and the importance of structuring contracts to protect clients. Lender requirements. What must be verified? Lenders impose strict requirements before approving a commercial loan. These often include property appraisal and valuation, review of leases and income, rent rolls, borrower financial statements, environmental assessments. For example, a lender may require a Phase 1 environmental report before funding a loan on an industrial property in Phoenix. If issues are identified, additional investigation or remediation may be required. These requirements can significantly impact the timeline and structure of the transaction. Debt Service Coverage Ratio, DSCR, measuring risk. One of the most important metrics in commercial lending is the Debt Service Coverage Ratio, DSCR. This measures the property's ability to generate enough income to cover loan payments. For example, a DSCR of 1.25 means the property generates 25% more income than required to cover debt obligations. If the DSCR is too low, the lender may deny the loan or require additional equity from the buyer. Understanding DSCR helps agents evaluate whether a deal is financially viable and anticipate potential financing challenges. Loan timelines. Aligning with the contract, commercial loans often take longer to process than residential loans. This creates a direct connection between financing and contract timelines. Agents must ensure that financing contingency periods are realistic, closing dates align with lender timelines. Extensions are negotiated when necessary. For example, if a loan is expected to take 60 days to close, but the contract requires closing in 30 days, the buyer may be at risk of default. This ties directly back to Section 3.1 on timelines and cure periods. Real-world scenario. Financing impacts the deal. Consider a buyer under contract for a multifamily property in Mesa. The buyer secures financing, but the lender's appraisal comes in below the purchase price. The lender reduces the loan amount, requiring the buyer to bring additional funds to closing. The buyer negotiates a price reduction with the seller to keep the deal together. This example shows how financing can directly influence negotiation and contract outcomes. Agent responsibilities. Guiding without overstepping. Agents play a key role in helping clients understand financing, but they must remain within their scope of practice. Under AAC R4281101, agents must exercise reasonable care and recommend that clients consult with lenders, financial advisors, or attorneys when necessary. For example, an agent should not advise a client on specific loan structures, but should help them understand timelines, risks, and the importance of working with qualified lenders. This ensures compliance and protects the agent from liability. How financing connects to the bigger picture. Financing is the bridge between contract and closing. Without it, even the best structured deal cannot move forward. This section ties together multiple concepts from earlier chapters, including contingencies from Chapter 2, timelines from Chapter 3, risk management from Chapter 4. As we move into the next section, we will explore advanced transaction scenarios and real-world problem solving, bringing together property types, leases, financing, and negotiation into complete deal analysis. Online discussion. What is the capital stack in commercial real estate? Answer. The capital stack refers to the different layers of funding used in a transaction, including equity, senior debt, and sometimes additional financing. Why is a financing contingency important? Answer. It protects the buyer by allowing them to cancel the contract if they are unable to secure financing within the specified time frame. What does DSCR measure? Answer. DSCR measures a property's ability to generate enough income to cover its debt obligations.